Okay, so with a bit of excitement, Brendan, I want to welcome you onto the platform. And while I've got you coming live here, I'd like you just to talk a little bit. I don't know if you've got any slides that you want to share, or if I've got some stuff I want to share basically. But yeah, what I'd like to do quickly is before you get going, I just wanted to let everyone know that whoever's live now, is the first people to know that Brendan's deal is now live on the WealthE Migrate platform. It went live like 10 minutes ago. And so we are truly in pre-launch phase, and truly the people that have walked this journey the longest, quite frankly, with Brendan and I. And I mean, if people do or don't remember, we came a long time before anyone else actually, because Brendan and I went to America back in well, him and I had been going independently 2010, 2011, but actually we went together in 2012. And it was really him and I that brought you America. We were the ones that invited, Henny and Jaco and years later Michiel and etc. And so it's really quite exciting, Brendan, that what you've been doing there with Infiniti. And for me, it's extremely exciting, and I'm very grateful to have you on tonight. But more importantly, for all the investors who know you well, to have your deal live on the platform. So I just thought I would mention that. I don't know if you've even seen, but you're all live on the platform.
I got a WhatsApp message that said it was live, and I was like smiling from ear to ear when I got it. I just want to say, like, well, two things. Thanks for having me on, and also just like congratulations, guys. Like, I got to catch a few minutes here of what you've been chatting about, and I must say, like, what you've been building is phenomenal. So I'm really impressed, and to get to a point where you now can implement a global system where people are online in multiple assets with diversified across currencies, assets, sponsors, geographies, with small amounts of money. Like you've pulled it off, and well done.
Well, as you said to me, Brendan, many years ago, it's going to be a lot harder than you think, Scott. But you were right there. But credit to Lyndon and Paul and all the Gavin and all the other team members. We're getting there. There's so many. I really think we need to acknowledge all the team members. I know Siska's online and everything, so there's been huge amount of teamwork. I know Merch is up late trying to get your deal live, and it's live. So I don't want to mention names because it's been a team effort.
No, it's phenomenal, man, and thank you very much for inviting us to be a part of it. I'm excited to be able to finally have a deal on that's got some momentum. So let me just run through it quickly. I'll give you. I know everybody's under pressure on time. And it's late there in South Africa already. So I'll give it a quick overview, and then if anybody's got any questions, we can drill into it. But let me tell you the story of how we were able to access this deal and a little bit about the deal itself. So one of our investor partners that's been working with us for a while over here in South Africa, his name's Greg. They own a company called Spartan Truck Hire. I'm sure most people have heard of it in South Africa. It's probably the biggest, if not one of the biggest logistics companies in South Africa. Greg's been investing independently, him and his dad, their own money in the US since around when we started, strangely enough, Scott. So they did it on their own, and they went in with Greg's cousin, Alon. Now, Alon is an ex-South African. He moved to the US when he was about 12 years old. So he's pretty much an American now, but still has a strong link back to South Africa. And Greg and his dad have been investing with Alon in around $250 million worth of transactions in
we just lost Brendan.
Sorry?
We lost you there.
We lost you there for like 10 seconds. If you just repeat that.
Okay, so I was just saying that Greg has been investing with his dad in Alon's deals. Alon is the sponsor that brought us this deal. He's an ex-South African, and he's got a platform of around $250 million of assets under management. They have very, very wealthy families out of Israel and South Africa that have, and the US that have backed them. And the only reason we got access to Alon is simply because Greg knows us, and he says, look, he wants to work with us on some deals and work with us in South Africa. And Alon was pretty much allowing Greg and his dad to ride along with him in deals that he was doing anyway. And then we came to the table and said, okay, let's do something together. And then the first deal that came along, we lost. We got pipped at the post. As you know, what happens in the US is you end up in a best and final bidding scenario. you've got to show the proof of funds, you've got to show your ability to close, you've got to show all of these things, which luckily we had. We just exited some deals, so we had probably $15 million in the bank at the time, so we could show proof of funds, and we still lost 2 deals back to back because of other people that were willing to go hard on deposits. And when I say hard, they're willing to do a non-refundable deposit of $1 million without a due diligence period. And we just can't match that level of commitment to a deal, because I like to verify what the seller is saying before we stand a chance of losing money. So we'd never go hard on a deposit up front, and people were being very aggressive in the market. So we lost a couple of deals. And then eventually this one came along, and we were actually just trying to buy one of the assets because, we've never raised on a $75 million deal. To go and raise $22 or $23 million in equity is a hell of a lot of money, especially if 90% of it's coming out of South Africa. So $20 million in perspective is 300 million rand. So to get people to move on time, that quantum of money was quite a big task. And when the seller came back to us and said, look, the amount of work that we're going to go through to try and sell all 5 of these assets, and you only want to buy the one, we don't want to do that. We want to sell the portfolio. So we got together with the investment committee, which is myself and Kevin and Jared and Greg, and we had a good chat, and we said, okay, are we going to take this on or not? Luckily, we had a bit of a head start because we'd exited some deals. So we had some money in the bank from investors that were willing to roll into another deal. And we said, yes, let's go for it. So we signed the purchase and sale contract. We flew out to Oklahoma. We walked every single property, and I got more excited than I've been in a very long time, because the amount of deals that we look at, just to give you some insight, is very similar to what CrowdStreet does. Like, we'll look at 200 deals and try and buy 5 and maybe win 1 if we're lucky. So when we got the opportunity to buy this at a 6.3% cap rate, which if anybody's active in the US at the moment in the multifamily space, you'll know that most deals are trading, if it's B-class product like this is, which is very good quality product in good neighborhoods with good quality tenants. It's not low income housing or anything like that. Is most of that stuff is trading at a 5 to a 5.5% cap rate, which means we've got a very significant discount going into the deal. And the reason we were able to get the discount was there were 3 primary reasons. One, the brokers worked with Alon before and has sold properties to him and bought properties, or at least sold properties for him. The second one is we'd lost the other 2 deals through the same broker, and he was very much embarrassed because the one deal we'd actually been verbally awarded the deal, and the next day we got told, no, somebody else put down $1 million hard and you're out. So the broker wanted to make it up to us. And the last one was, we said, look, we'll buy all 5 properties in one go. You don't need to go through the headache. As you can imagine, if you're a seller in the market as hot as it is now, you're going to have lots of different offers, lots of buyers, lots of tours. And the guy just wants to get on with his job now. He wants to move on and go and deploy their capital into more A-class product. The reason they're doing that is they listed. So they listed their company last year, and they're moving out of B-class product and into A-class product, which means they're going to have lower yields, but they've got a much more sort of presentable balance sheet as a listed entity. So we said, look, we'll buy the whole portfolio. We'll say yes, but then we want a reasonable price, and we'll make it painless, and we will do our due diligence thoroughly without messing you around. And they said, okay, that sounds fantastic. Let's sign and let's go. So we signed, we paid our deposits, and we're now, our due diligence period actually expired yesterday. Well, today actually it was. So we're now in a situation where our deposit is hard, it's non-refundable. We've had our 45 days free look, and we're very, very comfortable with it. I want to give you some insight into the level of due diligence that we do. We walk every property, we get third-party appraisals, we get environmental reports, we get title reports, we get engineering reports, land surveys. I do a thorough analysis of 3 years of the financials. Luckily, when you're working with a listed company that's selling, they generally don't lie because they don't like going to jail or losing shareholder value. So they are very, very, very forthcoming with information. And the more information I got, the more excited I got about this deal, because the income was not only real, it was getting better. So as we were doing our due diligence, they were renewing leases, like they're normally operating a property. And typically when a seller is in a period where they've in their mind sold a deal, they stop really paying attention. In this case, they didn't stop paying attention. They're very, very, very sophisticated. Their staff are amazing, and we'll be taking over their staff as well. And it's extremely exciting to see that the numbers actually got better as we were going through the due diligence process instead of getting worse. To give you a breakdown of what are the numbers. So we're purchasing this property all in with closing costs and legal fees and due diligence fees and all of our flights out there and everything for approximately $75 million. The deposit that we require is about $23 million, and the debt that we're getting is from Morgan Stanley at $52 to $53 million. They're giving us a bit of a slush fund for capital projects. And the reason they're giving us that slush fund is we believe and they believe that we can roll out a small value add play as a test. So what do I mean by value add play is we'll take that slush fund, which we're borrowing from them, at roughly 3.7%, which is phenomenal. But we're going to take that and go and test out a value add package on some of these properties. So we'll go and do a renovation. Let's say we'll spend $3,000 on one unit, $5,000 on another, and $8,000 on another, and then we'll test what kind of rental upticks we can get on those particular units. And if it validates the capital expenditure, we'll then roll out a full value add program to boost the returns. This doesn't mean that we have to roll out a value add program. This property produces at minimum, right as it stands today, without doing anything out the gates, we'll be able to distribute 8% cash on cash to the investors every year, and we pay out quarterly. So even if we do nothing, we're going to have 8% distributions. And then in terms of what's our potential upside over here, and I just want to say why I'm personally investing in this project, and I'm investing a lot. Infiniti's putting in about $1.1 million. So we put our money where our mouth is. It's really a case of co-investing alongside everybody. And we couldn't buy this level of deal unless we had people coming in with us. And most of the time, the people coming in with us can't buy this level of deal on their own. So it's very much a symbiotic relationship that we have with our partners and our investors. And we look for assets very similar to the way banks underwrite assets. We want to make sure the income's real. Now, the upside I'm talking about here is we have to ask ourselves, what is the probability if after 5 years that we've been in this project, is it probable that we could increase rents every year by at least $30 a month? Now, we've got 827 units here across 5 different assets. So what I love about that is you diversified from day one, and I'd rather have 827 tenants paying me than 5 or 6 or 7. I mean, I know a lot of people have invested in some commercial assets and stuff, and when one commercial tenant leaves and it's 20 or 25% of the cash flow, all of a sudden you don't have any cash flow. So I like diversification. I like multifamily because of its inherent diversification. And then if we ask ourselves the simple question of increases, is if we're increasing the rent at least $30 a year, there's 2 things that happen. One, nobody leaves for $30. Why? Because it's too expensive for the tenant to go and find another unit, pay his deposit, pay a truck rental, take the time out to pack all of his stuff, move down the road, hire the labor to do it, because in the US, labor is expensive, and actually move. So for $30, generally people don't move. What also tends to happen is in a market that is under pressure in terms of what's available, like ours are, which is why we're running at a 96% occupancy at the moment, is they generally don't have another place to go to that isn't more expensive than we already have. So they just tend to stay. So if we say, well, we increase it, it's like the frog in the boiling water. We just do a little bit. We do $30 this year, $30 next year, $30 the year after. And in 5 years' time, before you know it, you're at $150 premium on your unit. And if you take that on a cap rate basis, you've got 827 units at $150 more per unit. You're talking about roughly $1.5 million in extra net operating income that we can distribute to investors. So it takes our 8% cash on cash up to about a 14-15% cash on cash in 5 years' time. But on top of that, on a cap rate basis, if you take our $1.5 million extra income and you divide it by 6%, current market rate is actually 5.25%, but on a 6% cap rate, you're looking at a $25 million capital upside on this property, and we're putting down roughly $23 million as a deposit. So we're looking to double our money in 5 years if we can just increase rents $30 a year, $30 per month per year. So if I ask myself what's the probability of that happening, I think it's reasonable that we can expect to double our money in 5 years. And then on the downside is if we don't get that at all, we're still collecting 8 to 10% cash on cash returns, no matter what happens, even if we don't push the rent up. So for me, it's about risk mitigation. I want to know my income's real. I want to know I've got diversification of income across multiple tenants, multiple assets, multiple geographies. And then I want to know that the probability of upside is there. But even if it doesn't happen, I'm still going to get my income. And what's a very important point here is we were able to negotiate with our lender to take out certain covenants in their lending documents. One of the covenants is the debt service coverage ratio. So to go a little bit deep into the sophistication level here, is a debt service coverage ratio is simply the amount of income as a percentage on the debt to make sure that if your coverage ratio changes or goes down, they can then force you to put more capital in so that their exposure, risk exposure, doesn't change in the assets. Now, what's extremely important about this clause is if you have a debt service coverage ratio over the full 5 years or 7 years, is if a recession happens or a downside event happens, like a 2008, and we have to discount our rent to keep our tenants. So let's say we have to discount by 10%, which, by the way, was the worst performance on average in the US in the last 50 years, was a correction of 10% on the rental income. If on normal managed assets. So if we have to discount it by 20%, if the bank forces you via their debt service coverage ratio to put more capital in, you stand in a risk where there could be a capital call because the bank's changing their mind on how much risk they've got. We were able to get Morgan Stanley to take those covenant ratio clauses out of the lending documents. So we've got a debt service coverage ratio going into the deal on the day we close, but then we've got no coverage ratio after that, which means we've got a cash flow buffer to protect ourselves in a recession where we can't lose the property and we don't have to put more money into the property if our income changes. So this is about risk mitigation more than anything else. We know our income's real. We know our income can go down a little bit in case a recession happens and it doesn't affect our ownership or our capital call position, and it doesn't force us to sell, and it doesn't force us to put more money in, which is very, very important. And then the next level up is what's my probability of upside. And I think the probability of upside is very, very high. If I'm putting in $1.1 million and I double my money, I'm very, very happy in 5 years to have a $2 million payday. So the term of the investment is 5 years. We've got debt terms, 75% loan to value on a 10-year fix, which means we've also managed to mitigate the downside risk on the debt. We don't have a gun against our head in 5 years' time to sell the asset or refinance the asset or find money because we're under the gun. What we have is we have time on our side with very good debt terms. And just to give you guys perspective, because of the trade war that's going on in the States and China, is people, money is running to safe assets, which has created the US Treasury rate has run all the way down to about 1.7%. And because our debt is linked to the Treasury rate on the day that we close, we're currently coming in at around 3.6 to 3.7% interest, which, if you're buying at a 6.3% cap rate and you're getting interest on an interest-only mortgage at 3.6 to 3.7%, you can imagine the cash flow is very, very significant. And that's really the pitch, guys. So if you've got any questions, let me know.
Awesome. Well, thank you, Brendan. While you were talking, I've obviously gone onto the platform. I've also gone through your brochure, which is quite frankly the longest brochure I've ever seen in my life. I kept going down and down and down and down. I couldn't believe it. But what I see you've done, obviously, is you've got all the projects plus all the details and everything. So for the right brain people, you can read the first 10 pages, and for the left brain people, you can read all 180 pages. But the point being is that it is all there and all the documentation there. You can see in terms of the risk categories, it's at a core plus for all the reasons that Brendan has explained. Sorry, let me just close this down quickly. I think that's pretty critical. If anyone's got any questions, please just type them up there or put them up there. Obviously, we've got Brendan live. We are actually doing a live launch with Brendan to our entire community next Tuesday, so at 7 p.m. South African time next Tuesday. However, what we wanted to offer was to all the previous investors, all the LLC investors, was to effectively offer the pre-launch. I know there's there's not a huge amount of time on this deal. I think the closing date is the 27th of September, if I remember rightly, Brendan.
Yeah, that's correct. So at the moment, we're aiming for the 27th of September. We're looking pretty good to close by then. So we've actually raised pretty much all the money. A couple of investors might run into some timing issues. So it's a case of first come, first served at the moment. We've probably got, let me just check my spreadsheet. Hold on for a second. We've got about $1.2 million left to raise. So if anybody is interested, you really are fortunate right now to have a first look advantage before Wealth Migrate launches it to their whole platform. And I would say, like, if you do have the money sitting available in the States or anywhere else in the world, there's a very strong reason why I love this type of stuff. And I'll just tell a personal sort of quick story here. Is I changed my investing perspective to pretty much only buying income producing assets over the last 3 or 4 years, and what's happened is as it's played out over time, is it's put me in a very, very strong financial position on a personal basis, because I now never worry. I can travel the world with the income that I'm producing out of my real estate investments, and it doesn't actually matter if I do another deal or don't do another deal, because of what I've been buying, which is exactly this stuff, which is producing income for me now without any problems. And I've seen how it produces income consistently over time, as long as it's managed properly with good quality managers, and we really make sure that that is in place, with a lot of incentive programs built in to keep the management team honest and to keep them on point. And it's been very empowering to have a US dollar income stream that's phenomenal, to give my family the freedom to travel. I mean, I'm in Canada here doing the webinar with you guys because we're able to travel wherever we want.
That's actually just because you live in America, but you're actually a refugee that can't stay there.
Yeah, pretty much. I got to do a visa run.
I know you well enough, and I know that everyone here knows you well enough that I'm allowed to say that. So.
Yeah. But from next year, I will be permanent in the States anyway. But, it's given me the freedom of choice to be able to do what I'm doing now without stress or pressure or panic decisions or anything like that. So if anybody's investing, I mean, I know why lots of people invest in diversified offshore portfolios, which is why Wealth Migrate exists. But I thought that was just like, it's my personal story on why I love these assets. I've had the benefit of, I mean, if you look at our Infiniti's track record, we built a $160 million portfolio in 4 years, and this will take it to 220 odd million, somewhere around there, 230 odd million in assets under management. And it's been a hell of a journey, but at the same time, it's just because we protect investors and we only buy income producing stuff that really works.
Brendan, a couple of questions here quickly. I'm conscious, sorry, I'm going to have to jump off in 7 minutes. I've got a meeting with Hilda, but just quickly, so if I do need to leave, I might have to leave anyway, and I can leave you and Lyndon to finish any questions. But Andrew's asked, is this a hard 5-year deal? Do you have to sell after 5 years, or can shareholders vote to extend?
So there are two answers to that question. So no, it's not a hard 5 years. We pretty much want to have the opportunity to stay in for longer if we want to, which is why we took 10-year debt. We also got a better interest rate on 10-year debt, so that worked very much in our favor. So we want the optionality. If there's an option, the way Infiniti gets paid is we have a 6% preferred return to investors, anybody that puts physical cash in the deal, and then a 30% promote. So 70% goes to the investors, 30% goes to the sponsor group, of which Infiniti gets about half of that. And Alon, who's providing his balance sheet for the debt and all the property management stuff, he gets 15% on the investors' money as his promote. So on that basis, we look to exit at around 5 years, 6 years, because that's actually when we get paid a reasonable amount of money. If we've doubled investors' equity and we can get paid $2, $3, $4 million on exit, we've got a very real incentive to do that. However, if it's producing great cash flow and we don't have to sell and it's just working, we'll judge that in 5 years' time. So it's not a hard thing where we are going to sell definitely in 5 years. We're going to judge what the market is doing at that particular time, and if it makes sense to sell at that time to exit and everybody makes money.
Who's managing this project day to day, and what is their track record?
So Alon is managing it day to day. Well, besides the staff that are on site that have been employed there for the last 7 or 8 years, that by the previous owner. So they will be our on-site team, and there's about 45 staff members across the board that we're taking over. So they already know their assets, they know how to run them correctly, they're great management people already. And then Alon is taking over that management, and he's already got a $250 million portfolio that he's running of about 4,000 units. He's got a phenomenal track record. His delinquencies are excellent. His bad debts are excellent. His ability to take an asset that's already good and make it better is phenomenal. I've seen the financials on the last 9 deals that he's done. So my due diligence on them was to validate what was he pro-forming when he pitched a deal 3 or 4 years ago, and then what did he actually deliver. And every single deal he out-delivered what he said, what he put on the spreadsheet in the beginning. So I'm very comfortable deploying funds with him and having him manage the assets. But at the same time, we like keeping people honest, so we built in some protection mechanisms there, so that if we need to get rid of the management because they're not performing, we can. But we have to put them in alongside the existing manager, because he's under terms with the lender that he must be a co-manager at the minimum. So if we do replace him, he effectively just has another management company alongside. But we're very comfortable to have him on as the manager with our protection clauses built in.
Are cap rates compressing or releasing now?
Well, what's phenomenal about the US market in general is cap rates are compressing, especially in multifamily and especially in B-class assets. We did our market research on the Oklahoma market, and we found cap rates in B and A class assets are between 4.75% and 5.25%. So in Tulsa and Oklahoma, in B class assets are about 5.25%, and we're buying at a 6.3%. So in the current market rates, if we had to sell this at a 5.25%, we'd make a $10 million profit tomorrow. We did take the REIT doesn't want us to sell this asset within the first year, because obviously if somebody bought it from them and sold it in 6 months and did a flip, and they published their reports that said they sold it for X amount and somebody else sold it for more than that, obviously then they're going to be under pressure, because they're going to be like, well, why didn't you guys just sell it for more money? So we undertook that we would not sell it in the first year, but technically we've got a $10 million discount. And how do I know that that's real? Is there are already backup offers in place right now north of $80 million. So if we don't close, the property sold the next day to someone else for more than we paid for it.
One of the deals you showed a few years ago, you told us that you checked every lease. Did you do this here?
Yeah, checked every lease. We actually have a full team in the States that does the due diligence. So I didn't personally read 827 leases. No, I've got to put that on the table. But what we do is we have a team of people. So we've got 8 people that went to the property. They walked every single unit. They read every single lease. They did a full lease analysis. If anybody wants that, you can actually get the lease analysis from me, a full ledger analysis, and then a comparison of that lease analysis against the actual bank statements to make sure that the money is actually arriving in the account. And then what I do is I spot check. So I then go and check about 10% of them to make sure that whatever our analysis team is doing is telling me is actually the same thing that I'm picking up. And the analysis team actually picked up more stuff than I picked up on the leases. So I'm very comfortable with them. And that was Alon's team that did it. And the level of detail that they went into was exceptional. Most of the time when I'm getting a rent roll analysis from somebody, it's very, very basic and very light. I'm very happy with the level of detail that they went into. And then I personally spot check about 10% of them. So yeah, I've read 80 leases. It wasn't any fun.
How have your other Infiniti deals performed?
So our worst performing deal, we exited before a capital call on a development project that was very, very high-end $4 million condos in Sarasota, where we actually sold our equity position in the project to one of the big investors there and we made an 8% markup on our membership interest. That was our worst performing deal. And obviously, when it's a development deal of high-end luxury apartments where you're relying on the sale of those apartments as part of the capital stack, it had inherent risk in it. I don't like development deals. We actually didn't want to do that deal, and it came up right around Christmas time, and we said what we'll do is send out a text message to a few investors that were available at that time, and we raised $3 million in literally 6 days, and everybody went crazy because the returns looked so phenomenal. And we said, look, it's high risk stuff. It's development for sale product. Anyway, we sold that out. We made 8%. Our best performing deal to date is a 31% IRR, where we built 262 apartments in Kingsport, Tennessee. We happened to be in a situation where the project is in an opportunity zone. If anybody's been in the States or researched the States, opportunity zones came up as a tax incentive program through the Trump administration to boost real estate investment. And we couldn't get the benefit because we started the development before the opportunity zone allowance came through. But a buyer could get the benefit as long as they bought it before lease up had taken place. So we ended up in a fortunate position where we were able to exit the project very successfully, as if it was already fully leased up. So we took all lease up risk off the table, and we made a 31% internal rate of return. But we were very happy to keep that property. And at the moment, just because I got a report last week, I asked the guys that finished it out to send me a report just so that I can see what it looks like completely done. And they're already at about 65% occupancy after 6 months of lease up, which is phenomenal. So we would have been fine in terms of income over there, which is why we built it. Then on some of our other projects, we've...
Brendan, sorry, mate, just a quick one. I think this is very valuable, and if you and Lyndon can stay on and keep answering questions. Lyndon, I presume you can see the questions. Would you mind taking over from me? I do need to exit though. I've got Hilda online on another meeting I need to go to with her. So I just wanted to thank everyone. You know, you've all got my details. You've all got, you know, Lyndon and Brendan's details. If you've got any questions, I'm very excited about what you're doing, Brendan. As I said, we've been trying to get into multifamily, you know, literally since we got there in 2012. So the fact that you've got a strong partner on the ground with, you know, a couple of $100 million of track record, I think is very exciting. I'm very grateful that we're getting to share it with all our investors. So thank you very much. I don't want to close down the webinar for those that are asking questions. I don't want to stop this, but I do need to duck. So what I suggest we do is I'm just going to stop sharing my screen and I'm going to mute myself, and the meeting can go on, but I'll then join Zoom and say good night to everyone.
Perfect.
Great, thanks, Scott. Appreciate you being online with us tonight.
Thank you, Scott.
Brendan, the next question was, who decides on the exit strategy?
So that was the second part of my answer. Sorry, I forgot to actually bring that in. So the investment committee effectively decides, and we do have a voting system where all investors can vote on an exit in terms of a sale or a refinance or anything like that, as long as it's outside of the pro forma. So what does that mean? Is we've built our pro forma that in each year for the next 5 years, as long as we hit a certain number, we don't need a vote to sell. And that number would produce a 16 to 17% internal rate of return to the investors. As long as we beat that, we can sell without a vote. So that's at the management discretion. If we're under that, we need a vote, and then it needs to be unanimous. So if we're in a situation where we have to sell because the market's bad and we're selling for less than than our projection, then the investors do have a say. If we're better than our projection, we don't have to vote. In terms of who would we sell to, at the moment there is so much capital competing for product in the States that it's an open playing field. Like we've got family offices, wealthy individuals, private equity houses, insurance companies, public REITs and private REITs, all trading the same quality product that we are trying to buy right now. And it's like going onto private property and looking at how many houses are for sale and how fast they trade. If they're priced correctly, in the States is like, that's the multifamily market. It traded $175 billion last year. It's the biggest market sector by far across the world. It's the most stable market sector across the world. Number 2 behind it is medical. So in terms of stability and market liquidity and stuff, is it's very, very, very liquid in the States. A lot of people and a lot of types of buyers buy these types of assets. And then the last one is, if we hit $1 billion, we're going to reverse REIT ourselves. So they call it UPREIT. We'll basically convert it to a listed entity and look to exit in that fashion. And everybody benefits very well if we do that, which is basically a carbon copy of what the existing seller has already done. So they bought the assets out of exactly these assets. They then listed, they pulled out a whole lot of capital. They're now deploying that capital into A-class product, and they're slowly winding down their B-class product. We're going to just cut, copy, paste what big investors are already doing.
Great, Brendan, thanks. What is the difference between Class A and Class B?
So Class A is really the expensive stuff. And this is a very great question, I must say. Well done to have asked that, because it's pertinent to the Oklahoma market, and particularly the assets that we're buying. So Class A is effectively, what we're buying here is 30-year-old Class A. So we're buying mid-1980s Class A product. So Class A is what is the new stuff now, where it's obviously got much higher end finishes, usually smaller units, slightly more modern, etc., etc. Now, on Class A product, what's extremely important is it's expensive to build. So for us to be able to replace our product right now, even as a Class B product, which is good quality, good neighborhoods, but slightly older product, Class C, for example, would be more like Section 8 housing or affordable housing, more workforce guys that are earning $2,000, $3,000, $4,000 a month. Class B, our tenant profile is earning more like $4,000 to $10,000 a month. They're stable income producing families. So those are like the major differentials. What's extremely important here, though, is nobody can build Class B product in our markets that we're buying in and make it make sense. So what tends to happen is when new developers come to the market and they go buy a piece of land and they want to build a multifamily development, they go build 300 Class A product instead of Class B product, because they have to, based on the cost of building, be able to rent those units for between $2,500 and $3,000 a month, which means it creates this disparity between Class B and Class A products. Our tenants can't afford to go from their $800 to $1,000 a month up into a $2,500 a month apartment. So they've got their own niche of tenant profile that they aim at that we don't want. And what's extremely important here is the Class A product is what takes a knock first in a recession. Because everybody that's renting $2,500, if they lose their job or they downscale, they go and rent from us in B-class product. They don't want to go to workforce terrible housing in Class C product, but they're happy to go pay $1,000 a month for a nice apartment in a good neighborhood with a good school district. So when people downgrade, they go to B-class products. And then when people come out from, let's say, single-family homes or something, they go into B-class affordable products. So what tends to happen is we've got this huge inherent demand, and we've got this big gap between $1,000 a month that we can charge and $2,500 a month of what new product can charge, which means nobody can build competitive product, which means we always end up in an undersupplied and overdriven in terms of demand situation, which then drives our rent growth. And with our rent growth, that drives our capital upside on our exit. Great question.
Brilliant. And then the last one for tonight is a bit more information about your partner. So what is Alon's business name and his surname?
Can go look him up. It's called Ferndale Realty Partners, or Ferndale Realty in Boulder, Colorado. His name is Alon Jonathan. So you're welcome to look him up. He probably won't take your calls, guys. We've got a great relationship with him. He's not going to do deals with any investors outside of doing deals with us, simply because if you look at it from a sponsor's perspective, he doesn't want to work with 20, 30, 40 partners. He wants to work with one. He wants to say, I've got a great deal. I need $23 million. Make sure it happens on this date. And we do all the hard graft, raising the money, dealing with the investors, dealing with all the communications and the tax questions and all that stuff. And then all he has to do is do what he's great at, which is find and run great properties. So it's a great symbiotic relationship that really works. But yeah, go look him up. Ferndale Realty in Boulder, Colorado.
Great. My sense on this is that question was probably more about doing due diligence on the partners as part of their decision here, rather than to try and find a direct relationship.
No, look, I mention it because a lot of investors that have the financial ability tend to want to go work on their own. If they want to deploy $5 to $10 million and say, look, I want to just do a deal with you on my own. And what's interesting about Alon is you actually can't. The only reason we got the ability to do deals with him is because of our relationship with Greg and the family connection there, and he force functioned it to be able to go and do deals with him. Otherwise, we wouldn't have this opportunity. So it's a very real opportunity. But yeah, I share it openly so that you can go check it out.
Brilliant. Brendan, thank you. Great having you on tonight. I know we've got the official launch next week. There's a part of me that's that I know I think if I remember correct, there's a 2 million gap on this particular deal that you reserved for the Wealth Migrate clients.
Yeah, we can make space. So we've got about 1 million left to raise in terms of our minimum threshold. What's nice though is the way the Morgan Stanley debt has been arranged is if we raise more money, we simply get slightly better terms. So what will happen is we'll go from a 3-year interest-only period to a 5-year interest-only period instead if we put slightly more money in, which is and that amount is roughly $1 million. So that's why I know we can still actually push the envelope a little bit. We can close with only $1 million, but if we put in $2 million, we're going to get better debt terms.
All right, great. There's a part of me that's hoping that by the time we do this launch officially to our members next week, that we might have some sad news for many of them who want to invest at that point. So listen, great having you on this week. Thank you very much. Looking forward to doing this again with you in a week's time, specifically around your deal. Everyone who was on with us tonight, thank you. It's been great having you online. A really good set of questions, both on the initial part of the webinar around the LLCs and the way forward, as well as to Brendan on this deal. Please do reach out to me or Scott tomorrow or the next day if you have any questions around either of these two parts to the webinar. We really do want to prioritize finding solutions and adding value to the investors. That's at the core, I think, of both Wealth Migrate's values and certainly Brendan joining us tonight. I know he shares those from Infiniti side. So guys, thank you very much. Appreciate it, and hopefully hear from many of you soon.
Good night, everybody. Thank you for your time, and thank you, Lyndon, for the invitation. And I'm super excited. So look forward to seeing you guys on board.
Great. Thank you, everyone. Have a good night.
Bye-bye.